Hello, everybody. Here it's Rich Fournier from the Fournier Real Estate Team in Barrie, Simcoe County area. We do work at Remax, just in case anyone wants to know. I'm absolutely excited to bring to you one of our key partners in our real estate business. His name is Jake Abramowicz. Hopefully, I'm not killing that last name.
Cool.
He is one of the best professionals I've ever worked with in the real estate business. He saved my clients many times, and I'm really excited to bring him to you all today. He has a huge reach. He's very client focused, which it's not just about the deal for him, and that's why I'm bringing him to you today, because the industry's changed in the last 18 months. Real estate's changed, and I thought it was very important to bring someone who is extremely knowledgeable, understands the business, but also understands what's happening out there in the mortgage world. So everyone, please say hello to Jake Abramowicz from Mortgage Edge.
So I'm Jake, and I just have to say, for compliance reasons, I'm an agent at Mortgage Edge. My FISCO is M08003274. So I'm a fully licensed agent, and I really appreciate coming on board. I love talking to you all the time. As you know, Rich, we always have our chats, and that's kind of how this whole thing started. Was we had a great conversation one day, and you said, why don't we do a Zoom call, because we could bring a lot of value to people who are listening, and these are just private conversations we're having that so much information is carried back and forth. So I really appreciate talking to you, because we are always on the same page and the same level. So thank you.
No, it's great. I'm a little bit of a nerd. I'm always looking at what could happen or what is happening in the marketplace. Some people call me a bear. I'm not really a bear. I'm just looking at what's realistic out there in the marketplace today. I think there's lots of real estate transactions are going to happen over the next year, and there's lots of help that we can give to people out there today. But I think it's important they understand what's happening today and what is probably going to happen over the next 18 months. So before we get started, though, I do want to, Jake's not the type of guy to really brag about himself. And the reason why I'm going to bring up some of this is that there's a lot of mortgage agents out there in the marketplace. And Jake is one of the best in the industry. And the only way that you can measure one of the best is by how many people has he served. Business is about serving other people. If you serve a lot of people, you do a lot of business. And Jake does a great job of serving that. The numbers that he has done over the last 3 years is extraordinary, funding over $100 million with just him and his own assistant every year for the past 3 years. I think that was over 220 transactions on average per year. The 220 families served every single year with just you and your assistant. That's an extraordinary number. How do you do it? That's a lot of activity.
Yeah, it's a lot. So I'm a very high energy guy. I believe every deal is an opportunity. Could be today, could be in 2 years. I don't have a sales cycle. I never put people under the gun. I aim to, educate, entertain, and give as much information as possible and develop a relationship. And over 16 years, remember, it's taken me quite a while to get to a certain number. I think that I've developed a reputation where I'm straight, I shoot straight from the hip. People know it's an honest opinion. They know they're not being sold anything they don't want. I'm very transparent about my commission, what I make when I buy rates down. I give people discounts, etc., terms, how I get paid. So they don't feel like they're talking to someone who is necessarily trying to pull the wool over their eyes or giving them only one option. I tell them everything. Option A, B, C, you pick. You want option B? These are the good and the bad. So as long as people feel that they have options, that's great. Now, I know that when clients call me, I'm probably one of 3 people, hopefully, that they talk to, because hopefully people shop around. And at the end of the day, although rate is very important in my world, I find personal connections are equally important, and learning about that person's plan. It's not just, here's a 5-year, get lost, call me in 5 years. It's more, what are you doing? When will you move? What's your plan? Are you single, married? Do you have kids or not? Parents, are they retiring, et cetera, et cetera, et cetera? So it's just a matter of not looking at the numbers. I'll be honest with you. At the end of the year, I ask my broker, hey, what did I do this year? I know some of my colleagues focus on numbers tremendously, and to them, it's a goal target. For me, I believe that if I'm who I am myself, the numbers will follow, because people will find that I'm very passionate about mortgages, which is kind of weird because it's not a sexy topic. But I just find a lot of happiness thinking about all the people that I've met in the past who I'm at the point where they're now on their second or third property. And I remember meeting them at a pretty low income housing apartment or situation. They're renting a basement and now they're living in homes and they have investments. Mm-hmm. And I kind of feel like a part of that journey. And it's just a really rewarding feeling where, 16 years later, I'm still here. And listen, man, it's hard. Like, we're not robots. We lose deals. We take things personally. But at the end of the day, as long as people just give me an opportunity, that's all I really ultimately care about. And that rewards in the numbers.
What did you do before you were in this business?
I was a research analyst researching the new e-commerce space at the time. So I did a lot of reports and writing for a lot of the chief level people in Canada, IBM, Global Securities, Deloitte and Touche, Ernst & Young. So I'd show up. It was a really small company. We'd show up and we'd give our opinions on that market. And I've always had a big investment kind of background in terms of being interested in it. And just through osmosis, I got into this business. So it was just one of those things where here I am. And again, it's taken a long time to learn, right? We're not.
15 years is a long time, for sure.
And it's every single time I lose a file or I win a file, I still have to learn from what happened. Right. Especially losing files, because that's never a good feeling to work for free ultimately. But I don't ever want the client to feel that way. It's one of my mentors always says, no matter what, it's your fault. And it's true. And if we look at it that way and we learn from it, it's easier to move on to the next deal rather than, become a human and be really angry about it. So,
we experience the same thing in the real estate business. And, we do a lot of work for people, and most people don't understand how much work we actually put into helping them either buy or sell a piece of property. And it could take, you could spend 100 hours with someone and realize that it's not going to work out, and you lose that time, and you're never going to get that time back. But hopefully, you've done such a great job. You develop a great relationship for the future, and you've guided them in the direction that they need to be guided in, and they're not going to get hurt in the future. So,
yeah, for sure.
One question I get asked all the time, especially when I'm working with my clients. Usually we're the initial point of contact for one of your clients. And they ask me, what's the difference between working with Jake or an independent mortgage professional versus working with someone in the retail branch at a major bank?
Biggest, simplest difference is this. You can go get a pair of Levi's at the Levi's store, or you can go to a jean store and get a bunch of options. And that's really what we're all about, is we provide more than just rate. Now, I respect my colleagues at the branches. I work with them all the time. We share deals. We talk a lot. And it's important to have those outside relationships. And when I say outside, just for full kind of transparency, we brokers work with about 12 to 15 lenders, banks, credit unions, etc. But I have relationships at the banks that don't pay me. And the reason I have those is sometimes a deal that you and I are working on, for example, is specifically tailored for a bank that I don't work with. You and I would rather serve that client, and I would be that quarterback, because if I send it to a colleague I know, it's better than it being lost in the netherworld of retail banking. The problem and the biggest difference of retail banking, if I may say, is we are licensed. Every year we have to take re-education in our world. In the retail banking side, there is no mortgage license. You can be a mortgage specialist at a bank without really having any more than just simply training from that bank. And that bank may train you to sell stuff you may not need or want to sell to a client. So we have to just remember another thing. I'm 100% commission. If my phone rings, that's my moneymaker. I'm answering it as much as I possibly can. My bank colleagues, some of them work 9 to 5. 5:01 p.m. on a Friday, you're making a multiple offer. Saturday, you saw a place at an open house, you met somebody. They're not available usually. Now, that model is changing, but they're only selling one product. If it doesn't work there and you've spent 5 days waiting for an approval, this is where I've stepped in with you and said, okay, I can get that done in 5 hours. But what's happened so far? Well, they've gone to the bank and, they said yes, and then they said no. And that I hear that a lot. So I'm just kind of like your second or first option. And the reason that you should work with me is I can give you everything out there available, including the non-broker side. But sometimes I fully understand that a client is fully loyal to their bank. And maybe that bank is helping out with certain savings on other accounts, and we just simply can't match that.
Yeah, that makes sense. And to be fair, sorry, that's my phone dinging.
That's all good.
Even on the independent side, there's still a lot of people who aren't very good at what they do.
Absolutely. I'm always reading comments on Facebook and certain mortgage broker groups, and I'm astounded at how little education or understanding there is of a complex mechanism like a big loan. Now, that being said, the problem is if you're not always doing business, you're not learning, because you're not doing 3 to 5 deals a month. You know, if you're only pumping business to one lender, you might as well work at that one lender. What's the point, right? And so I again, if you're new to the industry and if you're starting, I'm here to help you. And I mentor a lot of other agents that are newish, and they always call me, what should I do with this deal, that deal? And I learn from that as well, because sometimes they know more about it than me because they're so focused on that one type of business that they're doing. But at the end of the day, yeah, I mean, in the brokerage space, in the bank space, there's good, there's bad. And that's just, there's no way around it. Like in every...
It's trial and error, right? I met you because I knew, we knew the Brow team in Toronto. Yeah. They decided to invite you out to have a conversation. I drove down to downtown Toronto. I liked your presentation. I liked you. You were straight up. You weren't dry. You were like, this is the way it is. And and it worked out for you and I. And it was a great day. And that's kind of what pushed me to start working with you.
Yeah.
Listen, I want to get down into what's really happening out there in the real estate space. I think there's a lot of misinformation out there within not only the lending space, but in the real estate space. I have some very, very strong opinions about the real estate market. I have some strong opinions about some of the real estate agents out there who are pushing clients into deals currently today that may not be in their best interest over the next 18 months. So if I say anything to offend anyone, I don't mean to. I'm just really opinionated about the space going forward, especially in the downtown core of Toronto. It's a different marketplace completely. We're on the outskirts of Toronto, up here in Barrie, Simcoe County area. And what happens in Toronto happens here. Mm-hmm. So what do you have? Well, before we see what we see happening in the real estate market over the next 18 to 24 months, why have we had such a big change with OSFI and the mortgage stress test? Why did they implement those that? Yeah, issue? So last night, a big issue for a lot of us.
Last night I wrote a year in review post, which I'm editing, and I can't wait to share it with you, because if any of your readers want to see it, absolutely we'll make our best to get it out there. So looking back in the last 18 to 24 months, we've had 2 stress tests. 2 years ago, we had the stress test for people with less than 20% down. And OSFI deemed those people to be high risk. Yeah. You can't save 20%. They thought, hey, maybe we should make sure you can afford higher rates. Last year, January 1st of 2018, so November it was announced, but January it was implemented. Yeah. We had the stress test for everybody. You have 20% down, 50 down, 5 down, doesn't matter. So the lenders now, everyone has to qualify at 2% higher. There were 2 reasons for this. The first was affordability. The Bank of Canada, OSFI, the federal government, everybody believes housing should be affordable. The second thing was they were really worried about a massive housing correction. Because if 20 to 25% of our GDP is tied to housing in one way or another, they're worried, well, if the housing corrects, that part of the market is in trouble, and then all of a sudden our GDP numbers are low, our economy is not great, and we have a big problem called potentially a recession. Now, the unintended consequence of this was simple. I have found that buyers, no matter what is placed in front of them, learn a way around. That's not to say they learn a way around the stress test. They just adapt. So instead of buyers buying houses in 905, they started buying condos. And so if the market's moving from one asset class to another, the market overall may not be doing great, but one specific asset class may be doing better than the other class. Mm-hmm. So when you're looking at condos specifically, we are now seeing investors jump into condos and buyers, first-time buyers, jump into condos because it's the lowest hanging fruit. And unfortunately, Richard, and I echo your sentiments here, there are some people that always say, if you don't buy now, you'll never get in. Moving to next year, I don't think that will really hold water moving forward in 2019, 2020, because I think we'll see a more of a balanced market than we've seen the last 2 years. I think the condo space has really run its legs. I think the detached properties in Toronto specifically are doing great. But as you get a little bit outside of the core, away from the subway lines, further north, things are a little bit more balanced, and you can attest to that more than I can. But the last year has been a real challenge with the stress test, because there's a lot of people that should have qualified that simply can't, first of all. And secondly, the whole idea of a stress test is this. We believe you should qualify at 5.5%. because today's rate is 3.5%. Unfortunately, it's now been 24 months since the first test has kicked in, and we haven't seen rates anywhere close to 5.5%. So if in the next 5 years, rates do not get to that number, why did the Bank of Canada and OSFI even come up with that number? Where did they get the idea that rates will climb that much? So and another thing that I'm noticing is the bond market has dropped significantly to its lowest level since March. If the bond market drops, rates are dropping. And I'm already seeing rates start to climb down a little bit. And just like
fixed or the variable?
Pardon? For fixed. So as a quick refresher for people, there are two types of rates, fixed, variable. Variable is dictated by Bank of Canada. Fixed is dictated by bond yields. It's very easy to tell where rates are headed. All you do is type in Government of Canada 5-year bond yield. You look at the chart. If you see the chart going straight up over a year, you know rates are heading up. If you see them going down, rates are starting to climb down or come down. And that's what's happening now is rates should fall in the beginning of 2019, January, February, March, just because eventually the lenders are just going to have to drop rates since they're now taking profits at the end of the year. But starting the new year, we should see some lower rates as well. So again, if the stress test point was, can you qualify at 5.5%? Well, sure I can, but I'm never going to need to get there because rates will never get to that point. So the last year has been a real challenge. Lenders have also really scaled back their net worth lending programs. We used to have, at 35% down. Yep.
Just for some of our audience, they may not understand what net worth lending is. Could you kind of explain what
So one of the biggest ways around the stress test was, hey, I may be self-employed, or maybe I'm retired, I'm a pensioner, or I make my money from investments. I don't qualify under the typical guidelines. But guess what? I've got 2 times my mortgage amount in a liquid savings account. I'm high net worth. Lenders have used that high net worth as a business case to make deals happen. Unfortunately, OSFI is going after net worth as well. They're saying, guys, it's all about income. And you'd be shocked how many people call me and say, hey, I make this much. Last year or 2 years ago, I qualified for 7 times income. What can I get today? Well, we're down to 5 times income. And that's a $200,000 drop on a $100,000 salary in terms of affordability and qualifying. So it has definitely been a challenging year because of the stress test. But the reasons that they came up with it was to hamper any sort of major housing collapse.
Got it. Now, I've seen recently in the last few days, we have an inverted yield curve. That historically, now don't forget, we're not financial advisors. I came from that world, but I'm not licensed in that capacity anymore. So this is just a conversation that inverted yield curve historically has forecasted a recession every single time. And how does someone make plans if there is a possibility of a recession, buying real estate and wanting to sell me or buying an investment piece of real estate? I think as agents on both sides of the equation, we have a responsibility to inform clients about these sorts of things.
Well,
I know it's not something we plan to talk about, but I'm throwing.
No. It's a good curveball. So first of all, if you were to bring a Government of Canada employee here, let's say a finance minister, talking about the recession, Stephen Polo's, the Bank of Canada governor, I don't think that word has come out yet in their vocabulary, which is kind of funny. When I hear about how good the economy is doing, and then I see the reality of it on the street, I just can't put 2 and 2 together. I can't predict if we will see a recession. But what I can say is this. If you're buying a property and you have your down payment saved, whether it's 5% or 30%, great. If you don't have a 6-month cushion, you're in trouble. Secondly, what kind of job are you in? What kind of industry are you in right now? Financial, manufacturing, education, public service, etc. So looking at every single client who's a first-time buyer especially, or who's a move-up buyer, that's how I kind of ascertain giving them the right planning. Now, I never say to a client, are you at risk of losing your job or anything like that? But we definitely have a general conversation about the strength of the economy, where their income has gone in the last 5 years and where it's heading up. Because if rates are rising at renewal, we want to be prepared for that as well.
Yeah, actually, I was looking at my rates that I think we're due 2021, and I'm probably going to be paying $1,000 more a month in 2021 based on
based
Right.
on today's rates. Absolutely. And that's the payment shock that the next 2 to 3 years people will have when they bought at a time where rates were 219 and now they're renewing at 349. And even though the mortgage balance is lower, they're going to pay more. So I've had a few clients call me and say, you know what, I'm renewing. I can't afford these payments. What can I do? Oh, you can finance, you can amortize to 30 years. There are some things you can do. It's not a big number, but it's starting to happen. I'm with you that I believe we are entering slowly into a potential recession period. And it's all going to be dictated by what happens geopolitically, what happens nationally with our economy. We're such a different time now than ever before with the whole issue with China, with the US, them fighting it out. We're kind of in the middle. So I'm a little concerned, but when I look at each client separately, I have the conversation with them. Can you afford this place today? Can you afford it at these rates in 5 years? And can you afford to maintain the property? How many of our clients have bought homes that are 20, 30, 40 years old that need a new kitchen, bathroom, etc.? You know, I hate those shows on HGTV. Those things are usually 2 to 3 times more expensive than what we hear about on TV, right? So if the answers to those questions are no, then, you know, we have a chat about, well, what's your plan?
Right. You know, even all of our clients, our buyer clients, we're having the same conversation where, listen, if you're planning on selling over the next, 2 years, maybe we need to revisit buying that piece of property. And if you're here for, if this is your home, you're here for 5, then, I'm okay. But we're having those solid conversations, especially if someone's planning only to stay for, around the 2-year mark.
You know, a couple of years ago, maybe 3.5 years ago, I had a client who worked in the armed forces who knew for sure he was being moved from one city to another within a set period of time.
Yeah.
Remember, this was 2015.
Right.
I said to him, "You're crazy. You're absolutely insane. You're moving in 24 months, guaranteed. What happens if your property loses value?" "Oh, that won't happen." Okay, and it didn't happen. He was right. He made 150 grand in that 2 years. But I believe that people got lucky. It wasn't a matter of smarts or whatever. It was simply a market was just on fire in our city. Things just kind of got out of hand, and now they're a little bit more normal. But if someone says to me, "I'm looking at parking my money for a couple of years, and then I'm looking at moving," I think to myself, okay, have you factored in double land transfer tax, the realtor cost of moving, the legal fees, the penalty, etc.? Now it doesn't make sense. I haven't had a single person say to me, "Yeah, I'm gonna, I'll stay there for a couple of years and then see." No, you're right. It's a 5-year plan.
That's great. That's great to hear, because we're very adamant with our clients that is this the right move for you from a financial planning perspective?
Totally, absolutely.
Things. Are there now? Again, I'm not saying this is the best move for everyone, but for some people, it may work out well. Is there a way around the stress test?
Absolutely. So a lot of properties have multiple units in them. Yeah. And a lot of the times, if it's not a legal, meaning not illegal versus legal, and you can talk to the types of properties, but let's say you have a nanny suite in the basement, an in-law suite, and there's some income coming in. If I can't use that income, and the clients, their cash flow would work with that income coming in, and we know that income rent is, say, $1,000 in the basement, $800. The way around the stress test is simple. There's a few ways. One, can we get to 20% down? If we can use multiple income streams, whether they are legal or non-legal, as long as they are a separate apartment. 2, are there parents that can help you qualify? And a lot of our clients have parents who are aging, and they say, "Well, my parents are retired. I don't think they can help." Yes, absolutely they can. Most parents who are retired and aging most likely have a property fully paid off. And even if they are on a limited income, say 20,000 CPP OAS, just for a frame of reference, every dollar you make, you can borrow 5 times that amount. A $20,000 income multiplies to $100,000 potential upgrade in the mortgage borrowing amount. So there are a couple of ways around it. Get as much down payment as you can, borrow against your parents' property as a home equity line of credit, make those HELOC interest-only payments for 5 years, refinance in 5 years to pay them back, and use income from a multiple income property. Or get more income on the deal from parents, co-signers, etc. that will help you qualify for more money. There is no other way around it other than having 20% down.
Got it. And every person's situation is different, and they have to do the right situation for them.
We just have to ask as many questions as possible. And remember, I'm the information gathering guy. I will take as much info to figure out the most number of possibilities around. The last thing I wanted to say is credit unions have really stepped up at 20% down. Some of them qualify at the lower non-stress test rate. Although the reality is the media made a big deal out of it. They thought everybody did. It is a tiny sliver of the market that lets you get into that type. So don't bank on a credit union helping you. If they will, it'll be at a much higher interest rate because they know they can charge you more if you're the only guy that can afford that property.
Got it. Now, can you help anyone in Ontario, or are you just kind of constricted to
coast to coast? To be quite honest with you, Quebec is our biggest challenge. Quebec has a different regulatory body. Most of my lenders work in Quebec, but only if you're licensed there. I do 99% of my business in Ontario, but yeah, it can be anybody in Ontario specifically. I like working in the markets that I know and that I'm getting to know, but we can, and if it's a client that's out further in a market I'm not aware of, I have a great network of colleagues that I would say, hey, let's partner up on this deal. You know the area, I'll quarterback the deal, et cetera.
That's wonderful. How can people reach out to you, Jake?
So I'm very active on social media. I was on Twitter. I've taken a little bit of a break. Right now, I'm mostly on Facebook, facebook.com/mortgagejake. I write a lot of blogs on mortgagejake.com as well. I'll be putting up my year in review very soon as well. So the best way is just my website or on Facebook. Reach out to me. I tell everybody, I welcome all questions, comments, anything. You want to be negative about it? Let's have a chat. Let's have a respectful chat, of course. But yeah, that's the best way to reach me. My email is jake@mortgagejake.com, and I'm at 416-910-4448. So I'm here to help. Text me. I get a lot of text message questions, believe it or not. A lot of Facebook inquiries, WhatsApp, everywhere. I'm everywhere.
I really appreciate listen, we work with a bunch of different people, but you're one of our favorites, and we really appreciate you taking the time to share some of your insights and about the industry and where the market's going. Again, we do recommend Jake, and if you do have any questions, don't ever hesitate to reach out to him. As always, we're here to help you make the right decisions in your real estate. Future buying or selling is a complicated process, and we believe that you need someone who actually gives a crap about you and who really wants to serve you. It's not about the transaction. It's about future relationships and to help guide you in the direction that you want to go, but without hurting you. So, Jake, thanks again for taking the time. Time is valuable, and we really appreciate you. And everyone who's watching this video, thanks again. We're always available, and of course, you know how to get in touch with us. Thanks again, Jake.
Thank you. Look forward to seeing you again.
Thanks, bud.
Bye.